welcome back from Sprott Money, sprottmoney.com. We are now into January 2025. It is time for your Ask the Expert segment. I'm your host, Craig Hemke. Joining me this month is my old friend, Ronnie Stoeferle. Ronnie is a fund manager at Incrementum in Switzerland. Where are you guys based again, Ronnie? Is that right? I can't seem to keep it straight. Anyway, you'll also recognize Ronnie. He and his team put out the tremendous In Gold We Trust report every May. Must reading for everyone in the gold space. And I know most everybody that's a mover and a shaker in the gold space does read it. And so anyway, Ronnie, thank you so much for taking some time to join me this month.
My pleasure. Is it already too late to say Happy New Year?
No, I don't think so.
It's not. So Happy New Year.
Yeah, it's mostly happy so far as well. Hey, and I want to remind everybody that at Sprott Money, always great deals on physical metal, but some big news recently is they're now storing metal at 2 new sites in the U.S. for U.S. customers. So it's always hard to feel real comfortable and, trustworthy toward those bullion dealers. Well, you can certainly feel that way with Sprott Money. And if you want to store the metal, they will do it in a very efficient and cost-effective manner. And again, now storing it in Dallas and Salt Lake City. So go to sprottmoney.com and check it out. Ronnie, talk about this In Gold We Trust report coming out every May. Ronnie, we're only 4 months from now, and you got to have another one. Let's start there. If you look back to what you wrote about last May, and as we move through the year, and now it's January, what have you seen? What has played out the way you expected, and maybe what hasn't?
Well, I think our gold call has been pretty accurate. We said that based on our model, which we introduced in 2020, we said the closing price of gold should be around $2,660. And when we made this call actually early on, people said, that this is way too ambitious. I was based on my forecast for Bloomberg, I was the most accurate forecaster for gold. So that's definitely we're quite happy about that. I think the main things, as you know, the report was called the New Gold Playbook. So basically, something has changed in the way that gold trades, which is this correlation with real interest rates has changed. We don't see any ETF inflows, especially from the Western world, which has always been a very reliable indicator actually for the gold price. So we said it is really emerging market demand on two different sides. First of all, central banks from emerging markets, and then on the other hand, private consumption coming out from emerging markets that are really now moving the needle, and they are really the marginal players in the gold market. So this has, I think, been pretty right. What we didn't get right, or perhaps we were too early or too bullish, was actually the mining space. So the miners haven't really outperformed gold last year. And silver, we would have expected a little bit more momentum, a little bit more leverage for silver compared to gold in such a tremendous year for the price of gold. But my take is we are, you're not being super contrarian, being bullish on gold these days. But we're far away from a top in the gold market. So I would say we're somewhere like in the middle of this bull market.
Well, let's kind of work through those one by one over the course of the show, Ronnie. Let's start with the U.S. economy, the Fed, what I have called the end of the Keynesian experiment, this debt that has, we're already $700 some odd billion in additional deficit spending in just the first 3 months of the new fiscal year here in the U.S., Ronnie. Where do you see the U.S. economy, Fed policy, rate cuts, all that stuff? Because that will have an impact as we go through the year. I mean, where do you see all that playing out in the months ahead?
Well, it's gonna be quite a ride. in this interregnum between the election and now the inauguration, there was so much being said and written about what Trump's gonna do, and I think it's really gonna be a wild ride, not only for financial markets, but also for politicians from all over the globe, because it's not business as usual. Obviously, it's not right versus left. It's more like accelerationists versus bureaucrats, and I think this is really the big change. And if we compare, Donald Trump's first term to the second one, I think there's some major differences. And first of all, I think that Donald Trump really understands what the median voter wants. And I think that therefore, immigration and inflation were like the two most important concerns that Donald Trump really articulated and addressed very, very well. But then on the other hand, you've got topics like uh, the debt situation that hasn't been that dramatic in 2016. Bond yields were not really constrained in 2016, 2017. When Trump started his first term, economic growth was very, very low, and inflation was no issue at all. So I think it's it's not enough to compare, or it is, you will make a major mistake comparing his first term to his second term. And of course, he will not be able to be re-elected. So I think it's going to be to some degree more radical, also more revolutionary, which from my point of view could be good, but also could be bad for some things. So I can only give you the European view, and everybody loves to hate Donald Trump. So so again, there's some important differences. I think equity valuations are significantly richer today than they were in 2016, 2017. So the S&P has more than tripled and trades at a 28 times earnings and 3.1 times sales, from my point of from what I know, versus what was it back then, 23 PE and 1.9 times sales in 2016. So I think the risk for capital markets are definitely higher this time compared to his first term. So I would expect, when it comes to the debt situation, and you said that I think every 3 months the US is adding like 1 trillion of additional debt, which is quite staggering, I would say. Um, I am not sure what to expect from this Doge project. From what I know, and I've read some studies about that, there's pretty little wiggle room when it comes to really cutting expenses, because so much of that is actually fixed. There was Michael
Right.
Chamberlain coming out, and he said 150 billion per year is, from his point of view, is realistic. Um, we'll see, but um, again, I think it's going to be quite interesting, and there will be lots of things to write about, to think about, to talk about. But I think what Stan Druckenmiller said recently, and this is really the most important thing at the moment. Druckenmiller said that the biggest danger is that global trust in America is eroding. And I think this is really one of the main things that we should be following. I told you before, I just came back from Saudi Arabia visiting the Future Minerals Forum, which is, I don't know if it's already bigger than PDAC in Toronto, but it's 24,000 visitors,
Wow.
mostly from emerging markets. So you've got obviously lots of participants from China, from Africa, from the Arabic world. And it's really interesting to see this new playbook when it comes not only to gold, but commodities in general, and how welcoming those regions are regarding commodity extraction, but also consumption, obviously. And I think that the world is clearly breaking into two different blocks. This is kind of the dollarization block, and then the other block, the BRICS emerging markets that I think want to get more respect and more recognition. And I think that gold, the price of gold and the flows of gold are a pretty good gauge for that geopolitical development.
Well, I think that's a great segue into the gold price here for 2025. As I look back last year, I thought we'd have a good year, but what did I miss? And I was like, well, I think I missed the impact of that central bank demand. It seemed like every dip was bought, and that all that central bank demand, which is a record level for 3 years running, seemed to be underpinning the price, kind of like a physical floor in a sense. One, I mean, do you agree with all that? And I guess two, do you think that trend continues in 25? Because if it does, you would think, again, those dips would be continue to be bought in an uptrend.
Yeah, well, I prepared a couple of slides for you and for the audience. Slide 5, for example, you can see, we had in US dollar terms 27% performance. But in euro terms, it's been 35% in what was it? Japanese yen terms, 41%, Canadian dollar 38%, British pound 29%. So I mean those numbers are staggering. And I wouldn't actually say that it's the price of gold rising, but rather let's change the perspective and say that those fiat currencies have basically devalued by 1/3
Yep,
against gold, which is pretty
yep.
dramatic and which shows you um, that this loss of purchasing power of fiat money measured in gold. Um, can this continue? The I'm really I'm really encouraged by this enormous strength of the gold price in such a tough environment. Because let's face it, U.S. Treasury yields, the 10 years, are trading at almost 5%. That would usually be big headwinds for the price of gold.
Yes.
Then we're seeing the dollar index is up by 10% since October. I mean, that's a big move. And then
Right.
we're actually seeing that, interest rates, the expectations for rate cuts have been basically priced out, which is usually also a very bad sign for the price of gold. And in this pretty negative environment, the price of gold is trading in US dollar terms and very close to new all-time highs. And today we've made a new all-time high in euro terms, and I think also in Aussie dollar terms, or let's say the Aussie dollar, the euro has made an all-time low measured in gold. And so therefore I think um, I wouldn't expect too much from gold over the next couple of weeks, to be honest. I think we're now in some side of a let's say digestion move. We're in this kind of sideways pattern, um, and I think this can go on for a little bit further. But from a technical point of view, such a consolidation, that's actually a sign that there's enormous buying power waiting on the sidelines. And I can tell you, talking to institutional players, everybody missed the party. So the big question for them, sitting at their investment committees now is it now too late? At what point, at what price level will we start buying actually? And I think that first of all, weakness in the US dollar. Second thing, more rate cuts than expected. And thirdly, a renaissance of Western investment demand. I think those will be the three main triggers going forward.
Let's shift to silver. You mentioned a few minutes ago, as everybody knows, a silver underperformed gold. I had 22% maybe in dollar terms versus 26 for gold last year. But it's off to a good start this year. It's up about 6% year to date. Copper has broken out of its downtrend as well and is moving higher. It looks maybe a good start for all commodities. What do you make of silver? Maybe it doesn't have that same central bank demand, but it continues to run this supply deficit every year. Where do you see silver in 2025, Ronnie?
I think if my take is correct that Western financial investors will come back, then I think at some point they will say, okay, well, gold is already a bit pricey. Let's
Mm-hmm.
consider buying, the little brother. And I think
Mm-hmm.
silver is one of the very few commodities that hasn't even reached the nominal all-time highs, and we're not talking about the inflation-adjusted all-time highs. So for me, silver, um, it could be actually one of the big surprises in 2025. Fact is, we're seeing very solid growth when it comes to the solar demand, which is now really being responsible for already the majority of the silver demand, which is quite staggering, I would say. And then you've got some, the this new battery technologies coming in that would probably need much
Yep.
much more silver.
Yep.
But I think really, what's really gonna make a difference is the fact that investor demand will kick in at some point. We're not there yet, but I think so. My view is that gold always goes first, and then silver and the commodity space is actually following gold. And I think that this phase could start this year. Actually, I can tell you we just launched a new active commodity fund, and the sentiment when it comes to commodities as is the worst sentiment since 2017. So everybody
For
hates
sure.
commodity investments at the moment.
Yep. Yep.
um, I think that has to do, of course, with everybody thinks that the dollar will continue to be strong, and that China is just further going down into deflation and economic weakness. And then everybody, of course, loves to hate commodities because of ESG. I think that the whole ESG trend is merely over. Um, and that's what we're seeing, especially coming from North America. So I think that this thesis hopefully will be correct, that gold goes first and then silver and commodities will follow. So those would be my highest conviction calls for this year. And as you know, silver is a tiny market, so
Yeah.
I think if there's really some investment demand kicking in combination with the very solid growth from the solar industry, that's like really the perfect storm.
Ronnie, you talk about things that everybody hates. How about the mining shares? That's probably a good place to conclude. You're supposed to provide leverage to the gold price, but gold was up 26% in dollar terms. And if you want to use the ETF as a proxy last year, it was up, GDX, it was up 8%. Even, and some of the biggest miners, Newmont and Gold and Barrick were down on the year. Very frustrating year for mining share investors. Is it as simple as like a growth versus value proposition that investors globally now are so focused on growth and specifically the high flying Mag 7, Elite 8, whatever you want to call it, that we need a reorientation of I guess sentiment toward value instead. And I think at this point the mining shares with the dividends they pay probably fit into the value category. What's it going to take, Ronnie? I mean, can we start to see an outperformance versus the metal this year, and what would drive that?
Well, well, I think it's important to say that everybody's staring at the two biggest mining companies being Newmont and Barrick Gold, obviously, and they haven't had a good year. They've been a pretty big disappointment, basically going flat or slightly negative in this tremendous environment for gold. Now, I can tell you just it might be a little bit anecdotal evidence, but that's what I'm seeing attending lots of mining conferences. You see the same male old faces at every mining conference, yeah.
Yeah,
And this is mostly people that are actually already invested. And we are managing funds in this space that have really outperformed the benchmark by a lot. And I can tell you, we're seeing very little inflows. So um, within the gold and mining bubble, there's not too much new capital that can be allocated. So you can reallocate capital, sell this, and buy something else. But everybody is waiting for the generalists coming in, and it feels like a little bit like waiting for Godot.
right,
Um,
right.
but I think if you put yourself in the shoes of a big institutional player, let's say an insurance company or a family office, and you don't really have a clue about the mining sector. Um, so you sit in your investment committee and say, yeah, okay, gold looks good. Um, Usually the mining stocks should profit from that environment. What do you usually buy if you're not an expert? You buy the largest stocks.
Yep.
And if you have a look at the charts of Barrick and of Newmont Mining, they just failed to deliver any leverage on the gold price last year. So I
Right.
would say that if those two companies should really make a turnaround, and from a technical point of view, I think the charts look pretty interesting. I think that could attract generalists really coming in. On the other hand, if we take those two large caps out of the sector, then we can see that some of the companies, also some of the companies that we own, had a hell of a year
Yes.
2024.
Yes.
Um, I think what's really, really encouraging is the fact that cost inflation kind of seems under control. So last year we haven't received the final numbers yet, but it seems that the ASIC inflation was like between 4 to 6%, something like that. What that means that many of the companies are really making record free cash flows, and their margins are just incredible. So I think at some point, also value investors will realize, well, there's an enormous amount of value and quality on the balance sheets of those companies. But I think that we will really need the two large caps performing better for the real big money to flow in, because it's all about liquidity, and some of the shares that we own, it's tough. It's easy to get in, but it's tough to get out sometimes. And if
Yeah.
you're like a multi-billion fund, of course you need this liquidity, and especially this stress liquidity, and you can only find that in the very large cap companies.
And Ronnie, when you see maybe the S&P falls by 100 points in a day and they talk about $400 billion in market cap wiped out, and the GDX has a market cap of like 14 billion, you think, oh my gosh, if just some of that money were to flow into our sector.
Well, I mean, the global wealth management industry is 128 trillion, and we know that this industry is heavily, heavily, heavily underweight gold, and the exposure to mining stocks is basically zero. So I think there's a long way to go, and I think Craig, that's really important. I think that equities aren't actually the, let's say, the enemy of the gold price, or the what makes me so bullish on gold. It is rather the bond market. So and we saw actually in 2022, when inflation actually finally appeared, the traditional 60-40 portfolio, which is 60% equity and 40% bonds, experienced the worst performance in decades. So the
Right,
S&P was down
right.
18%, and the 10-year Treasury index lost 15%. So I think that many people realize that bonds did not really act as a portfolio hedge to stabilize the portfolio, and gold actually did pretty good in that environment. So if you have a look at Charlie Morris put out a great piece recently um, where he basically said that if bonds are the benchmark, then gold is actually not in a bull market, but in a super bull market. And he showed since the year 2020, for example, the performance of the long bond, which is down 44%, and then on the other hand, the performance of gold since then, um, which is up 72%. So I think really the main secular case for gold is flows from the bond market into the gold market. I think that's really most important. And I have some sort of a mentor who always told me, if you want to make a case for your funds, for your thesis, you have to scare your investors out of bonds. And I think that's actually what's happening now.
Yeah, it's a very good point. And I had not really taken the time to consider what you said about I may really dislike Newmont and Barrick because their cost structure, and they just always disappoint, but we need them to turn around. That's for sure. I think you're absolutely right. Just to get people to think, okay, the generalist investor, the home office, like you said, says, oh, look, we can make money in this sector. So we'll root them on. I'm going to root you on, my friend. I know you've got 4 months or so until In Gold We Trust 2025 will be out. I look forward to reading it. Like, for everybody, again, if you're not familiar with the report, In Gold We Trust, it's hard to say, .com is the website, right? To keep an eye on it for when it comes out.
InGoldWeTrust.report.
Okay, there you go. So bookmark that baby sometime late May. Isn't that usually when it is, Ronnie?
May is the big day.
Let's go get them. Ronnie, thank you so much. You're a great follow on Twitter. I want to point that out to everybody too. Your Twitter X handle, Ronnie, is what?
Ron Stoeferle.
There you go. With a underscore or something in between or something in there, or is it just your name?
No underscore.
All right. Well, you can see it right there on the page. It's right down there. Well, maybe you can't see it. Anyway, look him up. Stoeferle. You'll find him on X. You can follow him. Ronnie, thank you so much, man. It's always so much fun to visit with you. And I wish you safe skiing on the slopes of the Alps this winter, and then get to work and get that new report out for us.
We will. So we're already working very hard on it. 15th of May is the big date. 21 people currently working on the report, and I think it's gonna be a good one again. We'll do our very best, and yeah, feel free to drop me a mail, message me wherever. If you've got ideas for the upcoming In Gold We Trust report, we're here to actually address what is most important in the gold market. So thanks for taking the time, or thanks for inviting me, my friend.
Just always great work, Ronnie. Thank you. And there'll be more to come even this month from Sprott Money. So keep an eye on this channel. Hit the like or subscribe button so you're notified. And it's going to be a busy year, so you're going to want to keep track of everything as we go along. But for now, we'll sign off. Thank you, everybody, for watching. Have a great rest of your day, and we'll have more content for you very soon from Sprott Money.